Hi folks, Travis Morrow here with Three Rivers Financial Group for another 2-Minute Tuesday. So today's topic, market volatility. Now, U.S. and global stocks have fallen sharply given the geopolitical landscape and have sent oil prices higher. So as of February 11th, 2022, the S&P 500 lost 1.9%, the Dow fell by 1.4%, and NASDAQ fell by 2.8%, and that was all in one trading day. Volatility has been high too, so after a sharp 7.5% year-over-year rise in the Consumer Price Index, stoked fears of a weaker economic growth amid rising inflation and potentially more aggressive Federal Reserve monetary tightening. All this to kind of summarize, St. Louis Federal Bank President James Bullard suggested that the Fed was considering an even more hawkish response than previously anticipated. Bullard mentioned his support for raising the Fed's benchmark federal funds rate by a full percentage point by this July. Concerns that the military conflict could affect global economics caused investors to seek the safety of things such as U.S. Treasury securities, which sent their prices higher and yields lower. So what do we do as investors? Well, number one, don't try to time the markets. It's nearly impossible. Time in the market, however, is what matters. Staying the course, continuing to invest, even when markets dip, may be hard on your nerves, but it can be healthier for your portfolio and can result in greater accumulated wealth over time. Number two, piece of advice, build a diversified portfolio based on your risk tolerance. So it's important to know your comfort level with temporary losses. Sometimes a market drop serves as a wake-up call that you're not as comfortable with losses as you thought you were, or that a portfolio you assumed was appropriately diversified, in fact, isn't. Now, if you're not a client or haven't yet established an investment plan, this is a great time to get in touch with us so we can discuss your individual risk tolerance. Number three, build in protection against significant losses. Modest temporary losses are one thing, but recovery from significant losses can take years. Traditionally, defensive assets such as cash type investments or maybe short-term bonds, they tend to perform better when stocks are down. Now, when used for diversification, they can help buffer a portfolio against the effects of up and down markets. You'll also want to consider defensive assets for shorter-term goals or accounts from which you expect to draw money out of within the next few years, such as retirement annuities that offer hedging and buffering tactics. And then finally, four, ignore the noise. It's hard to shift your attention when headlines and TV news are focused on the market drop. Historically, markets have fluctuated and recovered. It's important to stay focused on your plan and track progress toward your goal, not short-term performance. So in summary, volatility can be stressful, we understand this, but therefore a fiduciary-based advisor is important during these unsettling times, as what we do is we can take all the emotion out of your financial decisions. We can approach this from an unbiased standpoint. To learn more, call us at 509-783-2040. We are standing by, ready to serve you. Thanks again for your 2 minutes of time. Have a great week. Bye for now.